Welcome back. I'm Lee Tyrrell. For tonight's On the Money, we're focusing on an investing strategy that's designed to help you withstand the ups and downs of the stock market and ideally turn a profit. It's called dollar cost averaging. And joining me tonight to explain how it works, Jan Haagen, certified financial planner and founder of the Haagen Financial Group, which is based in Huntington. Jan, good to see you. Thank you so much.
Good to be back.
So dollar cost averaging is really all about not panicking when the market freaks out.
Being consistent.
Essentially being consistent.
Right.
Realizing you're in it for the long haul.
Right. And most people are doing it anyway with their 401k.
Right.
Yeah, every time you get paid, you put a piece into the 401k.
All right, let's take a look at some charts and graphs that we have to kind of help you understand how this really works out and what investing can really be a roller coaster with all the ups and downs. And a lot of us really do. Once the market gets up to that peak, we go, oh, this is a good time, let me jump in.
Exactly.
Wrong time.
Wrong time. Absolutely. That's the time to review and see what's been good, what's lagged, and then readjust.
And then we get down to that valley where, okay, I'm out, this is too crazy, too volatile, I can't do this, and that's actually the best time for us to be there.
You should be seriously looking at it, because if you liked it at the top when you're buying something at $50 a share, now it's $25. It's a sale going on. So
that's kind of the way. Oh, I like that. That's the way I have to look at it. It's a sale. Okay, I understand that better. Take a look at the next one. Chasing performance may lower your returns. Explain this one to us.
People are chasing the markets. Oh,
right.
This thing's really good, so let me jump in. Well, it may be at the tail end of its run, right? Or someone is stock trading in and out and in and out. Where are all those people that were day trading in the 90s?
That's right.
I don't see any anymore.
Yeah.
So that's not the way to do it for the long term. And then, I hate to say it, but media hype.
Right, that we were going to talk about that. You know,
Right.
a lot of us do. We get a lot of our financial information from what's hot in the media that day or that week, and that's not necessarily the best thing for the average investor.
Exactly. And just before I got here, I actually looked at what the market did today, because everyone asked, what did it do? I don't know. I never look, because I'm looking at the long term. It doesn't matter for that today.
Yeah, yeah.
It was up 72, so what?
Might be interesting entertainment for us to take a look at the numbers every day, but to somebody who's saving for their retirement, that's not necessarily the best thing to look at.
Absolutely.
Let's take a look at the next graph. And how long does it take to double an initial investment? This one really surprised me.
Yeah. It's really amazing. So many times you talk to somebody that's joined a company, and they're in the 401k, and they talk to the person in the next cubicle, if you will. What are you in? Well, I'm in the stable value fund, because it doesn't go up or down. It's nice and stable, but it's paying you 2.5%. At 2.5%, your money's going to double in 28.8 years.
Oh my. So
if that's a double, you're what age now? When do you want to retire? How many doubles do you have left? And can it double enough to get there? So the stable value fund's 2.5, so that's 28.8 years to take your 100,000 to 200. The market has on average been 10.25%. That's 4 times. Now that's a little extreme, I think, in today's markets, but if you look at 7.5%, that's about 3 times that. So in 28.8 years, your 100 becomes 2, becomes 4, becomes 8. That's a heck of a difference towards retirement.
Yeah. Anybody who jumped out of the market several years back when everybody panicked, how much better would they be doing now if they had stayed in?
There were so many people who said, oh, I stopped putting into my 401k.
That's right, I heard a lot of
You're getting better and better prices, so why get out? In fact, I have 3 people in my office. One of them, about a third of the way down when the market was really going down, got out. Got back in after it had turned again. His partner stayed in the whole time. And there was another chap that just kept adding and adding and adding. The first one is still underwater by a bit.
Really?
Second one is ahead by 5–10%. And the last one's ahead by 30–35%, because you consistently went in and bought at low prices.
So your advice is to watch the market, okay, have an idea of what it's doing, but don't react to the ups and downs immediately. Stay in it for the long haul.
Yeah, try and get rid of the emotion. Try and put logic into it. It's hard.
Yeah.
It's very hard. But if you can, you're going to succeed.
Try not to panic. Jan, thank you so much for the advice, as always. Appreciate it.
A pleasure.
That's On the Money. Still to come, Bill has a check on your 7-day hyperlocal forecast. Plus, the economic crisis in Greece.